Hey guys, I was debating whether to call this one Hope Springs Eternal or The Great Degrossing. I think they're related. I'm going to try to talk about both. But first, I want to play a little bit of this song. I thought it's a simple melody, one hand. Play this. There's simplicity in truth, isn't there? Anyway, check it out. It's All That Glitters by Mino Monterosso. Beautiful song. So cool. I wish I could make music like that. I need AI for music. There's some apps that do that, but they're not, you can't hum into it and then have it create music for you. That's what I'm waiting for. We don't have that yet. So hope is a human emotion. It's a very natural human emotion. Especially for Americans who are hopeful people. I was reading a couple of books this week, and I like to read multiple different books and different chapters at different times. I don't like to pick one book up and go from beginning to end. I like to focus on different chapters. Sometimes I start from the beginning, sometimes I start from the middle. I was reading about like the tulip mania. People were mortgaging tulips. It was wild. There's one guy in Holland. He was from England, and he had just arrived at this new place, and he was hungry. He mistook, in the dark of the eve, he mistook that these tulips were onions. He started eating them. The people, they beat him up real good during the tulip mania. And people are making these ever fine-grained distinctions around the nature of tulips and the quality of the tulips and the texture and the same kinds of fine-grained distinctions people make now when they describe the kind of earnings that Caterpillar has and why it's different than free cash flow yield or EBITDA, or the fine-grained distinctions in different miners and there's a lot of that, or different quantum companies. But hope is a human emotion. I have a guy that works with me in the office. He's on the client service side. He told me on Friday, I'm buying Tesla. I love Tesla. I like the product. I think it's amazing. I think Elon's an incredible entrepreneur. He has set the human species on a trajectory that's better. We're better off for the presence and existence of Elon, okay? And I said, we're bearish on that. We're short that. I said, you should know that. He's like, oh, but I believe in Elon or whatever. Like, I believe in Elon too, buddy, but that's not the same thing. 2 days goes by. He's like, well, no, I think it'll work out. We had a client join today. What's really cool is I can see all the positions. Like, I get a real-time gauge on sentiment. Client owned STRC from MicroStrategy, owned a boatload of Tesla. Was up 800% on Tesla, or 700% to their credit. They got in early, they held. Bravo. Good job. It's now down 40% from the peak. And it's not going to stop. Okay? It's not going to stop you. Get back in later. Get back in later. So the point is, people still have hope. People still have hope. And it's good to have hope. If you want to be an entrepreneur, you should have hope. Founders have a lot of hope. I think countries have a citizenry with hope that have inspired leadership and want to make their communities better. Those are better countries to live in. Europe is not a very hopeful place, in my experience, especially France. Everyone's dressed in black and goth and smokes cigarettes and complains about Americans. Okay? It's not a hopeful place, right? And they're brilliant people too. They're brilliant French engineers and mathematicians, but it's not an inspired place to live, right? But in markets too, people get hopeful, right? People, when asset prices drop, they'll say, well, let me just check on it tomorrow. Let's see how it does tomorrow, as if that adds anything really to the picture. Does it really add to the picture, or is it self-deception? It's really self-deception. It's like the number one thing that'll kill you in markets is self-deception. Not holding yourself accountable, being honest with your views and your expectations versus reality. Like, I'll give you an example. One of the things I'll do is, if we buy something, I only buy it if I expect it to work immediately. I'll give myself like 2 days for it to work. And even then, maybe not even that. If it doesn't work, I'm out, because it means my theory of the world is wrong. I had a concept I had a theory about the behavior of this asset. It did not work. I'm wrong. I'm out. I got feedback from the market. The danger is in re-underwriting your view. Well, maybe now it's better this time because of that. Okay. That's the slope of hope. That's deception. Now, what makes markets complicated is sometimes these phenomena can happen where some random event happened on a given day and all asset prices are impacted. That can happen now and then. But most of the time, that's not the case, right? So hope springs eternal, and hope can hurt you, right? Hope can hurt you. There's this old joke: take an atheist, buy them like the S&P, QQQ, Bitcoin on leverage, and they will learn how to pray, right? It's a form of hope. It's a form of hope, right? And people also confuse doing something with value added. And sometimes that works, and sometimes it doesn't. This is really a time to be patient. Okay, it's a time to be patient. Because there will be great opportunities. You're going to be able to act on them with cash. Okay, that's important. Let me talk about degrossing now. So, when I see asset prices move, I'm always trying to understand from first principles what's happening. Is it rates going up? Is it dollar strengthening or tightening in financial conditions? Is it sentiment shifts, policy shifts? What's going on? And what I see taking place, it's the great degrossing. Degrossing is another word for deleveraging. I'll give you a couple points of evidence. So one is margin debt hit record levels like 2 months ago. Everyone's all in. Hedge funds all in. You can look at that gross leverage of these hedge funds. It's way off the charts, and it's starting to pull back, okay? Institutions were all in. You can measure that through the cash they have on hand, which is a revealed preference. It's not a survey. It's like their cash on hand is at record lows. You can also measure it through sentiment surveys. So they were all in. And that's coming undone, and it's unwinding. So the good names, though, they're just selling off. You probably wonder, like, why? You did the work on this name. It's a good name. You're a good investment analyst. You did the work. It's still selling off. It's selling off because people are bloated and stuffed with securities. It's like they went to the buffet. They stuffed their faces full. They're bloated, and they had to fund it with margin. Like, they went to the buffet, and they opened up their coat. They stuffed I went to the buffet once when I was, 8 years old. It was like Ponderosa. I'll never forget this. I saw a woman go in, left an imprint in my brain, and she brought like this big bag and started stuffing it for stuff from the buffet. I'm like, huh? What's going on there? That's gross leverage. It's also gross. It's gross leverage. They all have to degross. Okay? That's what's happening in markets now. That's the bigger picture concept. Even BlackRock is degrossing, right? Their chief investment strategist, Wiley, came out and shifted their equity posture to neutral. Neutral on all indices around the world. US, international, everything. Neutral. Now they're 5 weeks late. Should have read the Lumina Ledger. We do have people from BlackRock reading the Lumina Ledger, by the way. I'm not going to call them out. We have them on there, which is cool. But, they're deleveraging. And a lot of RIAs follow BlackRock. They have these model portfolios. They really don't think for themselves, except for the people listening here at my podcast, my newsletter. Thank you. But most people just outsource the thinking to like Morningstar or BlackRock. It's automated portfolios. And finally, the committee at BlackRock got together after 5 weeks. I'm sure there was a debate to move from that consensus position, the old consensus to the new consensus. It took 5 weeks and price change for them to make that move. Price change is also what's required for a lot of people to move from hope springs eternal to let me protect. Let me admit that I was wrong. Let me take a different point of view. Price change, pain Pain is what does it. Pain. Okay? Yeah. So, you don't need to experience pain if you panic first, or if you have extra cash, or you're diversified, or if you're taking a lot of losses now, you're not doing it the right way. Okay? And you're making the mistake I wrote about. It's in phase 4. It's called Why Do People Lag the S&P? It's a phase 4 mistake. Phase 4 is the fourth phase of a market cycle in my framework, where you get deleveraging and asset prices sell off, and people that made money buying the dip lose money because buying the dip doesn't work anymore. Okay, and I still see it in my casual interactions with other people, or even on Twitter over the weekend. I see these nonsense comments around like buying these garbage stocks. They're garbage stocks, and they're trying to buy the dip and trying to do a community pump. And you have these self-styled investors that thought they were investors. They were really just marketers. They're really good storytellers and building a tribe, like Antonio Linares, the guy who pumped up like hymns. Then he pumped up Duolingo. These things are in vicious bear markets now, horrible bear markets. And they're still trying to pump these things up. They're not going to go anywhere, because eventually people throw in the towel. They give up the hope. They feel the pain. They're saying enough is enough. Okay? So where I see things is this. I created this deleveraging indicator, which is super cool. Create a fun little basket of indicators to measure things from different ways to triangulate. You got to triangulate in markets so you can stack your edges. So over the weekend, I shared an update on the buy the dip indicator. So cool. We have this strategy that just mechanically simulates buying the dip on thousands of securities. And then it just measures does it work or doesn't work. And it's just not working now, right? So what we created today was a deleveraging indicator. And markets are deleveraging. I can see it. I checked out what happened in 2022 and other markets. When you see deleveraging, asset prices start to go into distribution and then decline. When you see releveraging or regrossing, it's very bullish. And at Liberation Day lows, you had peak deleveraging, peak degrossing. And then after that, you had regrossing up until about September. And then you started to see degrossing kick in. And if you recall, the fall was a bit soft. October was soft. You had all these DATs and IPOs like Bitminer and whatever else start to lag and underperform. Quantum stocks rolled over in the middle of October. The hype bubble started bursting. So you saw deleveraging take place there. But the S&P continued to rally due to other names and other categories. But deleveraging and distribution was already taking place. You could see it in names like Exxon, for example, FICO, Palantir, SoFi, these crowded names marketed by these KOLs, okay? The KOLs still own this stuff, by the way. I went through 10 ETFs over the weekend that have been launched by these KOLs. They're full 100% long. They still own the same garbage. And not all it's garbage. Sometimes they're actually good names, but they're just badly priced and now have bad trends, right? I've been talking about industrials for like weeks now. That cracked today. Look at Teradyne, Caterpillar, John Deere, GE Vernova. That's done. A lot of KOLs own that stuff, and they're still holding the bag. They haven't made a single adjustment, and they're lagging the QQQ. QQQ is like down 10, 11%. They're like lagging that. So they haven't adjusted to reality. Hope springs eternal for these KOLs and their followers. Okay. So that's what I see out there. Hope springs eternal. The great degrossing will eventually finish. And when it finishes, there'll be great bargains. I did pick up Meta and Microsoft on Friday and Berkshire Hathaway. Meta did better today. I think it was up 2 points. I was disappointed in Microsoft's performance. Had a nice little pop this morning, but kind of a weak bar, and software doesn't look that great. Software has to rally here, or it goes another leg lower. It doesn't look good, by the way. I wouldn't kind of wait to find out, per se. There's some good names in software, but there are a lot of very expensive, overpriced names like MongoDB and Sentinel and cybersecurity stocks that are insanely overpriced. And now they have bad trends. And then when price starts going the wrong way to a holder, they start listening to other views because their amygdala gets activated to risk. And they say, gee, the FOMO gives way, greed gives way to fear. The only two emotions, fear and greed, right? There's growth, inflation, sometimes deflation, growth, inflation, fear and greed, right? So, and they see, gee, let me start protecting. And then you start getting more of these deleveragings, VWAP sell orders, and degrossing. That's what I see out there. I made my case for Microsoft, I think on Friday, right? I talked about the Copilot, this and that. It's a world-class business. They're slow to the punch on AI, just like Google was, but they have competitive position. They have the high ground. They have distribution. They're selling to all these big banks and healthcare companies and all these enterprises they can't switch. They're locked in and they're going to pay because they have security. They have other requirements that enterprises have, like the Fortune 1000 complex and others and governments and the US government's on Microsoft, right? They're going to eat the cost. So I think that you'll see that they'll do quite well, including with their cloud businesses. So picked up Meta. Meta was cheap, 17.5 earnings. Like, I'm not a big fan of their CapEx, but and unlike Microsoft, they are not putting that CapEx to a cloud business where they have the prospect of future enterprise revenue from enterprise clients, right? Meta is not a cloud business. They're betting on better recommender systems, better LLMs. They're spending a boatload of money. But at that price, like, gee, like, there's so much that's been priced in at that point. And I expect they'll do well on earnings. But those names also sold off because they were widely owned as part of the degrossing phenomena. Right? So what else? It may not be done being sold. May not be done. Microsoft might not be done. I have more confidence in Meta, but we'll see. And, I have hedges and shorts in other parts of the market. I'm net short industrials. I'm net short biotech. And I have certain software shorts also. So that helps in case I'm wrong on that long side. This might be the golden age of long short investing, by the way. It's possible. On Berkshire, I would say look at the price to tangible book ratio. It's 1.3 now. It could go lower. It got lower in 2022. If you think it's a 2022 bear market, then I'm wrong on that. If you think that we see the clouds break and there's some resolution around the Iran conflict, I don't think it happens anytime soon. Certainly not in the next 3 to 4 weeks, but could happen in 2 to 3 months. Then those are good buys. So that closed well today. That was good. I've been stalking this for months and months and months and months and months after poking fun at it, by the way, in May of last year. I have a post saying, why would you want to buy Berkshire? It's like buying treasury bills with a premium to NAV. It makes no sense. But, there's some value there, some value. It's like decent, but it's not, wow, let me back up the truck. I think it's worth a couple of points of exposure. So thinking, what else are we seeing out there? I think on the conflict and around, like, a lot of people are starting to re-baseline their expectations. White House is recalibrating expectations. The sell-off really started in earnest Thursday when market learned that there are no 15 points of mutual agreement negotiations. It was just a first volley. Trump was way ahead of his skis Monday last week. He created a 3-day rally saying that they had alignment on key terms. They were negotiating with someone. It was rumored that was head of the parliament in Iran. That guy just got taken out over the weekend, right? So there's no agreement anywhere. IRGC keeps denying there's any substantive negotiations whatsoever. Okay? It takes time to get deals done when you're acting in good faith. This is going to take time. The primary lever you have is kinetics. But I would encourage you, go to Google Maps, go zoom in on the Strait of Hormuz and study the coastline. Look at the cities there. Look at the populations there. And ask yourself, how many people with rockets are required to create a credible deterrent? And the other thing you should do is go study the Suez conflict in the 80s. The Strait of Hormuz was closed before. And U.S. convoys were sent in to help escort. U.S. destroyers were sent in to help create convoys and move tankers. Some of these tankers were shot at. It didn't play out well. But you should study that history. You should study that history. The U.S., of course, has studied that history extensively. But my read of things, and I may be wrong here. You let me know where I'm wrong. I'm open to be disproven. I want to learn. My goal is to learn fast, right? I share my theories about the world, and that's all you can really do. You have hypothesis. It's like a flashlight you cast out into the darkness, trying to look into the future. So my assessment is that there was a calculation made by DOD to take out the Ayatollah and his leadership, and that there would be bottoms-up public regime change. That hasn't happened. The evidence why I believe it's miscalculation is because there's an AWACS, the eye in the sky, that was taken out on a airfield in Saudi and some other aircraft, and missiles are landing in Israel still. What's going on with that? It looks like they're conserving interceptors. That means they did not plan that the conflict would take this long. Okay? So, and then you had this 5-day, hey, we'll stop attacking you and try to do a negotiation. What if that's just a gambit? I think it was a gambit. I said so last week. It was just a gambit. It was a gambit, right? And then, you need not just Trump to de-escalate, but you need the IRGC to de-escalate also. And the state of affairs is just not stable, right? If the U.S. was simply to withdraw, the IRGC would declare victory and start enforcing these $2 million tolls, which are nonsense, and it's not sustainable. And then the U.S. would have to get involved again. So it's not a stable equilibrium, right? And the quick hits seem to be accomplished, right? If you think about like the intelligence and the targeting, the IRGC, they're in bunkers now. They're not stupid. They're in bunkers making like meme videos, right? That's what they're doing. So it's you want to wait for some clarity and resolution on the ground, right? It's like, put your extreme fear indicator away, people. It's not that. That doesn't work here. That's not going to work here. Okay? You need facts on the ground to change. You need the price of oil not to go up. Went up again today. It could go up considerably more. Saudi is utilizing this pipeline they created in the event of the closure of Strait of Hormuz. They're max pumping the oil through that. I looked at the numbers on this thing. It's not enough. It's not enough. It's good that they did it, but it's not enough. And the time and money to replace the Strait of Hormuz is just, it's not fast enough, and it's exorbitantly costly. It's not practical. Okay, so that's not a viable alternative either. China was able to get their tankers through today. That's a good sign. So if you're China, you're like, this is great. This is great. Right? China buys oil much cheaper than the rest of the world because they're buying it from Iran. Iran's not selling at the global market price. Iran was selling at $40 a barrel before the conflict began. Now they have record revenues. And they were unsanctioned by Scott Bessent. Think about that. They're unsanctioned. So from the economic incentive perspective, there's someone at the IRGC that's making money. The state, they're making money, right? People respond to incentives. I'm not saying they enjoy being under the threat of being bombed, but there's another incentive out there called making money. And that's enforced. And the other thing to consider is, like, look at World War II, Japan, look at World War II, Germany. There was a tremendous amount of kinetics applied to get a surrender. Look at the Dresden bombing in Germany. Massive civilian infrastructure bombing, massive. Like Japan, massive. This is nothing. This is nothing. Okay? So I think it's a naive proposition to believe that they're going to roll over because we have kinetics. Okay, that's not enough. It's not enough. So you got to have destroyers, escort, and what about the mines? And where are the U.S. mine layers? We need one from the U.K., and the U.K. Navy appears to be decrepit. They didn't invest enough in that. So it goes back to this initial miscalculation around the duration of the conflict and a belief that the chain of command could be eliminated and there'd be a public uprising. I studied this too, by the way, so spent a lot of time researching this, learning much as I can. But think about Iran like American blue states versus red states. The blue cities are more liberal, more pro-democracy, okay? Like Tehran. That's where a lot of these protests are happening. The rural areas are far more Shia aligned, okay? That includes the coastlines, okay? You're not seeing protests there, okay? It's, so I don't think that's gonna be the answer either. I think Netanyahu had an extraordinary sales job on Trump. I think he did. I think he had an extraordinary sales job. And again, you had the backdrop of the politics of the situation, right? Trump's polling was low and all the rest, right? And now you've got the cabinet saying we want 50 years of peace. Well, if you want to achieve that, right, it's going to take a lot more time than markets expect right now, I believe. We need a new anchor. What's the new anchor? 4 to 5 weeks with the old anchor. We're there now. Okay, what's the new anchor? We're hearing words like soon. There's been no Pentagon briefing in 9 days. What's that about? Does that make any sense to you? No, doesn't make any sense, right? So, and, markets starting to question Trump's credibility because of what happened last week. Like Monday, he said, we're there's a deal. Rally one Monday, Tuesday, Wednesday, no deal. Thursday, an about face. Okay. So, that's where you are. Earnings growth is still good. It's crazy. Here's some fun facts. Micron will deliver 50% of the earnings growth of the S&P, according to the revisions estimates. Wild. It's insane. The stock sold off today, had a trend break. That fact I just shared with you doesn't matter, by the way, for how the stock price behaves. Mark already knew this, okay? Trends can break anyway. NVIDIA is going to crush their earnings next quarter too, and next month. It doesn't matter, okay? Just in a world of degrossing, doesn't matter, okay? It's a really interesting thing to understand. It's not just fundamentals that matter, but positioning and technicals matter too. And one phenomenon I saw today that we did not see up until today was the safe havens got taken out. What were the safe havens? Micron was a safe haven. Teradyne was a safe haven. GE Vernova, the industrials are safe havens. Light, names owned by, what's that AI hedge fund called? Built by this Columbia alum, the ex-OpenAI guy. Like, none of those names are working now. They were all taken out today. All taken out at the same time today. Pretty interesting to see. The gold safe haven was taken out last week, right? I actually started accumulating some gold, by the way. Okay, so when the fire burns down the house is cheap. Go get, maybe you should move in, maybe you should buy some land. But I think people were hiding in these crowded momentum trades, and one by one, those safe havens are taken out. The 10-year was taken out. So I do think there's some value, though, in these insurance companies, economically resilient quality businesses that don't actually have credit risk. Meta, Microsoft, NVIDIA's got all sorts of narrative hangover risk around it and positioning risk around it. It's part of the deleveraging also. They will do well on earnings. So a lot of this turns on time frame, right? What else? There are a lot of bubbles all over the place, though. Look at Oklo. The CEO's dumping his shares. Stocks down again and again and again and again. Quantum stocks down again and again. The SoFis of the world and you name it, right? These popular fintech stocks just down, right? So, the valuations in a lot of categories still elevated, like industrials, right? And that's symptomatic of other categories like biotech. Biotech's down again. We're short that. I talked about that. I think Druckenmiller exited his positions by now. We'll find out in his next Morgan Stanley interview when he pumps the next theme and tries to get out. People follow him, right? Even international stocks are expensive, So, yeah, I'm just telling you what I'm looking at. I look at a lot of data, people. Look at a lot of data. But yeah, my beta, my active hedge strategy is like 0.18 today. It's wild. We made money on our short side, made money on our long side today. That was good. That's cool. But I think deleveraging is not complete. You need to see facts on the ground change. You need to see hope snuffed out. You need to see a real capitulation. Maybe 6,200 in the S&P, maybe 6,000. I think if the S&P valuations got to 17 times earnings, which is what you had on around April 8th last year, you should be buying it very aggressively. I think if S&P got to 6,200, you should also be buying too. But, we have to assess what the conditions are at that point in time when we get there. You have to reassess and re-underwrite, right? I wouldn't buy stuff like Netflix or Tesla. Amazon's gone through multiple years of multiple compression now. It's still going through that. That's a harder call. I'm not terribly excited about it. Since their free cash flow keeps, diminishing as they invest more and more in CapEx, right? What else? I think you're going to see more headlines around private credit too. That thing is not done. I think international banks and financials have exposure to private credit, also like Deutsche Bank. So when the dust clears, though, consumer discretionary will be the move to make. They're getting really cheap, and household balance sheets are strong. They're very strong. People aren't planning travel and leisure right now, though. People are kind of freezing and just waiting for clarity. But when you see the clouds break, consumer discretionary, I want to own a bunch of that. I want to own financials. I want to own technology. I will want to own small caps because financial conditions will be improving then. That's what I want to buy on the other side of this stuff. Okay. And there are opportunities setting up. Like there are names that are very cheap. They're down 25%, but they still got pressure on them. Like cheap names get cheaper kind of phenomenon, right? So anyway, I hope you guys had fun. Thanks for joining. Don't forget, check out the Illumina Invest app. We rolled out candles, weekly candles with indicators on them. So you can see sell signals and buy signals at all point in time, pick up a random chart, see how it does. The weekly candles are great because they strip out the daily volatility. A lot of head fakes will happen when the VIX is over 30. Daily candles will fake you out so many ways. Look at weekly candles, look at the bigger trends, take a look at that. Not investment advice, of course. It's just a tool to add to your disposal. What else can I share with you all here? Some good books you can read. I think here's some books you should read to just recenter yourself and get historical perspective. Mobs, Mayhem, and the Panics of Crowds. That's one. Devil Take the Hindmost. That's another. There's another great book. I'll post some of these books later, but they are very entertaining. They're well written, and they focus on periods of history. I was reading the 1929 by Andrew Ross Sorkin. You know what I did is I went to the appendix. I looked up Jesse Livermore. I read that part of the book first. Then I went back to the chapters. So Livermore, you might not know, he made most of his money on the short side, actually. He was a contrarian. He studied philosophy as well, studied Aristotle. He was also, he realized the power of marketing. It's a really fascinating individual. So later on in his career, he did. So before the 1929 crash, he made his fame as boy plunger. A guy approached him and said, hey, let's write a book, a couple things about the market. And that book became reminiscences of a stock market operator. And he didn't really share much of his tactics or his edge in that book, by the way. There are a few concepts he shared in there. I've mentioned them from time to time on these videos. But I said, let me learn what this guy's doing. So yeah, he was short going into the 1929 crash in October, and the market had dropped 25%. And he was getting a lot of hate mail and people threatening to take his life. And he also thought that, hey, this is probably not good for the economy. Even though when you're shorting, you're just creating liquidity for someone else. All shorts have to buy their stock back at some point, right? He took out a newspaper article, or he announced to the world, to these reporters, that he had covered his shorts and was buying back all his stock. And he was long American stocks. And that was going into Q4 929. That was not the bottom either. So Jesse Livermore, made mistakes, made fortunes multiple times, destroyed fortunes multiple times. The guy just needed an MSCI Bora risk model or an Axioma factor model. He would have done a lot better. So we're going to build that into our Lumina app also, by the way. We have all these models. So we'll let you see, are you taking the same factor bet? Are you overweighted in certain categories and themes? Do you have incidental factor bets? That was interesting though. He made most of his money on the short side. He was a student of psychology, of Carl Jung, of Sigmund Freud, right? A lot of the people in these markets, they get their CFA and they work as an analyst. And they think it's about numbers in a spreadsheet. It's not. I went through that. I know that stuff. It's not about that. It's more around positioning and psychology going hand in hand, and things like crowdedness. And when the crowd is all in, you should take the other side. You want to be non-consensus. You want to have a non-consensus mindset. Stocks with good fundamentals can decline. That happened back then too. GM was around in 1929. That stock sold off too. It's a great business. It still is a great business, but it doesn't matter. Doesn't matter. Yeah, okay, earnings growth is going to go up. Fantastic, great. Doesn't matter, right? So when you have deleveraging, asset prices go lower. That's what matters. It's the flows caused by the deleveraging that matter. Okay? It's not a DCF spreadsheet where analysts are debating what fair value is. Okay? And when you start seeing new trends form and downtrends form, people's psychology changes. And then what you see now are markets rally and then they sell off. Maybe you get a 1 to 2 day rally. Maybe you get a rip and it sells off. Today you had a gap up open, people sell off. It's kind of like, if I were to give you a metaphor, there are people out there that want rallies like oxygen. Like imagine someone fell off a boat and they're in the ocean and they don't know how to swim. And they're just trying to get some air. And so when they get some air on those rallies, they're looking to sell. That's because they're over levered and they're trying to deleverage and they're waiting for the exit and they don't want to sell at the lows. They look at the chart, then it rallies and they said sell. That's my belief about what I think is happening out there. And then sometimes it doesn't rally. Look at the chart of SoFi. It's just red, 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 red. So what do they have? Hope. They have hope. I hope it rallies, then I'll get out. Or maybe I'll talk about this thing on Twitter, and then maybe people will start buying it. Right? Anyway, hope lasts eternal. You should be hopeful. You should be an optimist. Optimists make more money in the long run. But you need to be prudent also. You need to know, like, when you should be aggressive. Like, you got a war, you got oil going higher, you got inflation going higher. Germany's got higher inflation. The federal government's paying $200 billion a month now. Annualize that, you're talking $2 trillion. Rates are going to go higher. That's going to crowd out financing. Like, I mean, if you're not cautious now, like, what are you waiting for? Like, under what conditions in the world are you waiting for? What else could I add to that picture? How about valuations are elevated? What are you waiting for if you're holding on to hope right now? Okay. I'm not sure. What are you waiting for? A swift resolution? Is that what you're waiting for? Guess wait for the events to reveal themselves, and wait for the events to reveal themselves. And then you can respond, and then you can adjust, right? All right. Sorry if I'm just trying to be direct, straightforward. There's someone out there that probably needs to hear this. I might be wrong too. I haven't been wrong. The last 5 newsletters, we've been correct. You should be defensively positioned. There will be good bargains, there'll be good opportunities, but this is a hostile climate for risk appetite. That's the way to look at it. All right, be well, folks. Make it a great day. Cheers.